Right, very good morning, everybody. It is Friday, the 21st of June, 2024. Let's just quickly take a look at where we are from a sentiment point of view as we close out the Asia Pac and get ready for the European session. In terms of overall sentiment, it's another mixed bag across the board so far today. There's been very little signal when it comes to risk sentiment in a week like this. It's been mostly noise. And again, we've spoken about this quite a lot, but that's exactly what we would expect in a week like this, right? We have holiday thin conditions with plenty of US participants away, arguably taking a long weekend of the Juneteenth holiday that we had on Wednesday. That obviously creates some thinner liquidity, lower volumes, which can create some choppy price action, muted price action, if you will. We also have quad witching coming up, which is officially today. With the quarterly rolls taking place, that in itself can create a lot of two-way price action, a lot of price distortions. We've got the idiosyncratic drivers with the Eurozone political mess that's going on in the background. And we have a very thin schedule for US events this week, right? Yes, we had retail sales in yesterday's claims, and we have the PMI, flash PMIs today. But, let's face it, these aren't major tier one events. They are important and they can be market moving. But in a week like this, you wouldn't really expect them to have a massive impact on the needle, right? We would want something with a little bit more emphasis, a little bit more important for the markets, and we just don't have this week. So just keep that in mind. That's why, from a general point of view, we're not too surprised to see choppy price action, messy price action, if you will, because that's what you would expect as your baseline view coming into a week like this. Now, in terms of overall flows across major asset classes, equities on the US side took a little bit of a dump last night, slightly higher as we trade into the session now, but just marginally so. Now, the downside move caught a lot of players off guard, but it's worth noting that equities have been on an absolute rip over the last couple of weeks, right? Eventually seeing a little bit of short-term pullbacks, especially these types of marginal ones. It's just not very surprising when it happens. Also keep in mind that it was largely driven by Nvidia, which took quite a move to the downside. If we take a look at these charts of the big six, we can see that, or we know that over the last month or so, the majority of the upside that we've seen in the likes of the ES and the NQ has obviously been driven by Nvidia itself, and we went from 28% up month to date down to 19% month to date, which is still, think about it this way. You've got a over $3 trillion US market cap company giving you 28% gains in a month. You can't blame players that are long this to just take a little bit of profit off the table, right? At some stage, taking a bit of profit off the table is the responsible thing to do. So going from up 28% down 90, up 28% to up 19%, it's still fantastic for a $3 trillion market cap company. So, but that's the main trigger, the main driver of why we had that little bit of a sell-off. It's all really related to Nvidia. We did see some downside in Apple as well, to be fair, but for the most part, you can see these have been mostly flat. It's all been driven by AI, by tech, and obviously more specifically by Nvidia. In terms of the other equity markets, European equities did slightly better. I think that is just a lack of new stress on the political side. We had some more conciliatory comments coming out from the opposition parties in France, which I did think just calms things down a little bit. If we take a look at the spreads, though, we're pretty much where we were, going back to the last two sessions or so. We haven't really seen a lot of blowout moves or moves lower. So there's still uncertainty there, but European equities have definitely taken slightly more kindly to those words, those conciliatory comments coming out from some of the opposition parties over in France. Apart from that, Asia Pacific equities wetting the bed here. We've seen them down for the majority of the week. To be fair, we've seen them down from the end of May. It started to roll over. And I still hold to my view here that I think this is just down to the markets getting bored. They're getting bored with the fact that we haven't yet seen upside in growth that we've all been waiting for when it comes to China. We've had fiscal support, we've had monetary policy support. The last box that we need ticked is the growth to actually show some upside, right? Some upside surprises, some recovery. And we are yet to see that in the aggregate of the data. And that's why I think the markets are they're losing their patience when it comes to China right now. And that's why I think we're still seeing that downside pressure playing out here for Asia Pacific equities. Also worth noting that we had a pop to the upside in the VIX, as you would expect, last night. Now, we've spoken about this so many times before, but it's just worth noting again. at these levels, anything close to 12, you would expect at some stage for this to push up, not because the markets are getting suddenly more fearful about something happening, but when volatility, or let's call it this way, when buying protection is this cheap, it's kind of irresponsible for you not to do so, right? So just keep that in mind. We've seen these occasional moves to the upside in the VIX, and every time it happens, you get the fear mongers out there saying, oh, the markets know something we don't. No, it's probably just, it's very responsible to buy protection when volatility is this, when implied vol is this low. So just keep that in mind. Buy protection when you can, not when you have to, because then it's expensive. So that's what I think is happening here. Not too surprised to see this at all. It's at these levels. You can't blame players for just looking to buy up some protection, especially going into the weekend. So not too surprised by that move at all. But if we do see that continue, obviously that can put some additional pressure on US equity. So it's well worth just watching. In terms of commodity markets, mostly down from yesterday's solid run that we had, especially in precious metals. I mean, wow, what a move we saw. Gold ripping to the upside, silver ripping, not as much upside in platinum, but well supported. That was also on the back of copper moving up. To be fair, iron ore was slightly more traded slightly more sideways, but we even saw a little bit of recovery move in WTI. It seems like commodities have been well supported so far this week. In terms of the potential driver for that, I just don't know. Commodities have been a very tricky one for me over the last couple of weeks. From a fundamental point of view, I've really struggled to get on board either up or downside for these markets. So for now, I remain patient on it, but it's well worth just noting that big solid momentum moves we had yesterday in precious metals, very noticeable in terms of overall price action. In terms of the bond market, pretty boring stuff so far this week. Still seeing more downside than upside for bonds, i.e., upside for yields. But we are still very close to recent lows. So again, the main focus for now is on those peripheral spreads. It's on the OAT Bund spread. That's really where the biggest bond market focus is in a week like this. In terms of the FX space, the Aussie dollar keeps on surprising. I mean, it is pretty strange to see this currency perform as good as it has this week. There's a couple of things that suggest that this move is driven by something else, and I just don't know what it is. Because if we're assuming that it's all because of the RBA meeting that we had on Tuesday, I mean, go through the statement, go through the presser. Were they slightly more hawkish? Yes, in the sense that they said they didn't even discuss the possibility of a rate cut this time round, but they didn't do so last time either, right? The fact that they said we actually talked about hiking rates, they said the exact same thing last meeting, which in my view doesn't really back up the upside that we've seen in the Aussie dollar. When you consider that, rate pricing went from pricing in 16 basis points worth of easing to just 6. Now that's 10 basis points. You would think that 10 basis points is already reflected in the price right now for the Aussie dollar, which again makes the move a little bit strange. And there's some other key correlations which suggest that this move is it's a little bit crazy. Let's take a look at the dollar yuan. Dollar yuan, normally something that whenever you see downside in the yuan, because it's obviously such a key trading partner for Australia, even places like New Zealand, you expect to see a slight inverse correlation to the Aussie dollar versus something like the dollar yuan, or a positive correlation with the yuan and the Aussie, right? So if you just add in your currency index for the Aussie dollar, you'll see that relationship fairly clearly. We normally see a positive correlation. This is obviously inverted, so just keep that in mind. But you can clearly see the massive amount of strength that we've seen in the Aussie dollar versus the upside that we've had in dollar yuan, right? So again, this is inverted, just to show you guys what I mean. So you would expect this to actually move in the opposite direction. Now, if we go to the specifics here for the Aussie dollar, here you can see those two relationships fairly clearly. We have the yuan, the yuan dollar, basically, again, not looking at the dollar yuan, but the yuan this time around as the base, looking at copper, and then looking at the Aussie dollar. There's a very clear divergence here, and I'm just not sure what's driving it. I've been looking for a potential fade on it so far this week, but I just haven't had. There just hasn't been a clear opportunity to do so. But just take note of it. I mean, the Aussie dollar is just absolutely smashing it right now, and I just don't see a good enough reason for it. If it's all RBA pricing, I think it's overdone and it should be in the price already. When you look at things like copper, when you look at things like the yuan, even if you consider the fact that equities pushed lower last night, it's even Asia equities is pushing lower. It makes the move pretty strange. So I don't know whether there's other type of flows that we're not aware of. Maybe it's M&A flows that's supporting the Aussie. But whatever it is, it's this move is something that I'm very cautious of right now. Again, this isn't tradable. I'm not saying let's just go all out crazy shorting it. I'm not there yet. But I will be looking for opportunities to do so, though, because this move, it does feel a little bit overdone based on the price action that we've seen in those correlated markets. And obviously, the fact that I just don't really trust the move based on the RBA alone. Now, in terms of the calendar, we've obviously got the flash PMI data coming up a little bit later. We have UK retail sales due. Not excited about trading that at all, as we explained yesterday. Main focus will be on the French and the German data. Following that, we'll focus on the UK PMI data. And then a little bit later, we have the US as well. We've got previews obviously available for this, so do make sure to check that out. It can be interesting. It's going to be a little bit more tricky to trade these for the reasons that we explained yesterday. Obviously, with everything going on the political side, there's arguably slightly less focus on the data, more focus on risk premiums. But from a short-term point of view, it's still going to be important, and it can still be market moving and provide some potential tradable volatility in the session. So well worth paying attention to that. With that said, just take note, pretty messy price action still across the board. And again, that's exactly what you would expect in a week like this.